Hello. Chapter 5 deals with the time value of money. Let's explore. Money tomorrow is not as valuable as money today. So given the choice of having the same amount of money in the future or right now, everyone would prefer to have it right now. If money is available now, the possible uses for the money are as broad as possible. If the money won't be available until sometime in the future, then the opportunities for use are limited. Maximum freedom to choose is always worth something, particularly in uncertain times. Therefore, money to be received in the future must include a premium if it is thought to be equivalent to money today. Although every economic decision in mining involves cash flows, in other words, spending money, receiving money, occurring at different points of time. Consequently, economic evaluations must incorporate a way for equating these money values at some constant point in time, usually now, and that term is called the present value. So we bring everything to the present value, otherwise you can't compare the amounts. There's a big difference between corporate finance, in other words, costing, economics, and capital investment decisions, which is addressed in this text, and financial accounting, which stresses income and earnings. Accounting procedures document what happened, or they are in the past. Mining economics aims at informed decisions on what to do, so looking more forward. The objective of a cash flow analysis is to simulate all of the anticipated cash flows for the project over its life and express them in present value terms so that a decision can be made. The most obvious cash flows are revenues from sales, expenses incurred in producing the products, and capital expenditures necessary to bring about the production. Capital expenditures are tabulated in the cash flow in the year prior to their use. So you buy the equipment, or capital expenditures are the equipment. You buy the equipment in the previous year, and then you can use them for this year. So the cash flow for that starts before you actually start the production. Cash flow tabulation should normally commence with production, since almost all the revenue and many of the operating expenses are related to production. Operating costs are subtracted from operating revenues to obtain the operating profit. Working capital is the initial, for instance, the initial inventory of spare parts is one example of working capital. These are the inventories and things that you need in order for you to repair your machines or to do your production, other than the capital requirements. The biggest investment in working capital in a mine in the inventory is the inventory of advanced workings. For example, advanced overburden removal, floor stocks, stockpiles. Nevertheless, the mine plan typically provides for these in the mining schedule, so the cash flow associated with them is already incorporated, so we're not going to separate those out. They are already incorporated in the operating costs. Salvage value is the expected value after cost of the sale has been deducted that you realize upon disposing of the fixed asset at the end of their useful life. So what you believe it will be worth at the end of the life of the asset. And the timing of cash flows is very important. Timing is more critical in highly leveraged projects, for example, where much of the equipment is leased, and equally vital in three other areas. For instance, namely, these areas are: 1, commodities for which the prices change in cycles; 2, cases where less capital-intensive schemes are being upgraded to more capital-intensive schemes; and 3, during mine expansions. So more terminology. We're almost done with the terminology. Depreciation is the allowance for wearing out of the equipment. You buy equipment, and every year you use it, and it wears out, and later on becomes obsolete. And so depreciation is the allowance for that. Depletion is the equivalent to depreciation, but this time it's for deposit reserves. So it represents the declining value of the reserve that the taxing authorities permit a company to claim as a valid deduction from taxable profits. Tax credits are allowances permitted by the taxing authorities over and above the expenditures that actually occur. Tax credits enter the cash flow calculation only as an aid to calculating how much tax you actually have to pay. And then taxation is the amount of money that has to be paid to the government based on your operating profit. Taxable profit is what I should say. Oh, a little more terminology. These are all dealing with the time value of money. So present value, which we already talked about, but it's the estimate of the value of future goods received then when multiplied by the discount rate yields the value of future goods as if they are available now. That's the present value. So some money that you believe will be received in the future, what is that money worth now? Future value is the future, obviously. It's the value of an asset or cash at a specified date in the future that is equivalent to the value of a specified sum today. So if you had some money and you invested it somewhere, you could, at a given rate, you could anticipate what it would be worth in however many number of years. The number of periods, obviously, is self-explanatory. Compounding factor. Compounding is the process of reinvesting each interest payment to earn more interest. So you continue earning interest upon the interest. If an amount of money today, which is the present value, is compounded at an interest rate, I, over a number of years, and N, which is N, the number of years, then the future value is as stated here. So equals present value times 1 plus I, which is the interest rate, and then to the nth power. And that is the 1 plus I to the nth power is the compounding factor that you can actually find in the appendix in the book starting on page 263. So instead of having to do this with your calculator, it's easier to do this using the appendix. There's a big difference in this class between this class and your typical accounting class. I am a CPA, and I know that the accounting part of it. I also know the finance part of it, which is different. I know the economics part of it, which is different also. In accounting, you document what has happened, so it is past. The data is already there. In mining economics, we aim to make informed decisions on what to do and what investments to make. So you are trying to look in the future. Also for accounting, expenditures are apportioned over the period of useful work, like depreciation. In operating a business, we have to make allowance for cash flows when they actually happen. So even though in accounting, you don't expense that piece of machinery that you purchased until you actually use it, well, when you're trying to make these decisions in economics, you have to look at the $600,000, for instance, that you bought for a dozer, you spent for a dozer. You have to write that down now because that's a cash flow. Cash flow analysis involves simulating what is happening or what is expected to happen in the mine over time. It's forward-looking. So the purpose of preparing a cash flow is to be able to make a decision. The objective of a cash flow analysis is to simulate all the anticipated cash flows for the project over its life so a decision can be made. The most obvious cash flows, as it's listed here, revenues from the sales of products, expenses incurred in producing, and then the capital expenditures. So let's look at a sample discounted cash flow table on the next slide. This is the same thing that's on page 54 of your book. So if you want to follow along with that, either way it's fine. Capital expenditures are tabulated in the cash flow in the year prior to their use. So you see the capital expenditure right here is $15,000. It's in year 0 because you don't start producing and getting revenues until year 1. Cash flow tabulation should normally commence with production tabulated at the top or near the top of the table. Here's our production is up here. Since almost all the revenues and many of the operating expenses are related to production, revenues are also tabulated at the top of the table. Operating costs, as you see the operating expenses, are subtracted from operating revenue to obtain the operating profit. And the net cash flow, let me come down here. This net cash flow, if you're studying this, you take your after-tax profit, and in this case year 1, $180,000, plus your tax depreciation, which is $41.25, And that's where you get your net cash flow of 4305. The discount factor, 15% year one, if you look in the table in the appendix, you'll find this factor. This factor is taken times this net cash flow to get the discounted cash flow. These numbers at the bottom are the actual numbers that you want to look at to compare with the amount that you are spending. And so these are positive. The amount you're spending is a negative. And the net present value is 0. And what that means is this particular project is netting exactly, I think the cost of capital, yes, it's exactly a 15% return on investment, or it's predicted to be exactly that. So what you do is you compare the negative cash flows to all the positive cash flows that are discounted to the present value, compare those, and if your net present value is positive, then or zero or above, then you accept it, all else being equal. If it's below that, then you reject it. So that's just a quick one. We will do this in a little bit more detail in a later chapter. Working capital are the funds, as we said before, funds that are necessary in a business to cover the running costs caused by time differences between expenditures incurred to produce the goods and revenue received. Spare parts, for instance, held in the warehouse represents an example. Salvage value is the expected value realized upon disposal of fixed assets. So if you buy a dozer for $600,000, sell it 5 years later for $100,000, the salvage value is $100,000. It is a cash flow. And then depreciation, already stated, the allowance for wearing out equipment. It is a non-cash expense. So it's the proportion of the cost of plant or equipment that is charged against earning in the accounting period. We get to do that for tax purposes. Accountants like to think of that, and that if an item ordinarily lasts 3 or 6 years, then after 3 years it should be worth half of the purchase price. Well, you take half of it, and that shows what you are, how you are using it. That's what the IRS allows us to do. This may or may not be true. Accounting definitions of value should not be confused with a value for decision making. So accounting purpose value is way different than economic. Economic valuation, cash flow valuation, salvage value, that's all what you believe you can sell it for, what you believe it is worth at the end of its useful life. So how does a company decide whether projects should proceed or not, or whether one project's better than another project? The two most common measures are based on net present value, which I kind of briefed you on that a few slides back, or the return on investment, or also called the internal rate of return. That's the actual return that it is producing. In either case, higher values are preferable. So if a company's cost of capital is 10%, the net present value is $100 million after discounting the cash flows at this rate, then the value of the project is $100 million. An alternative project with a net present value of $120 million would be a better project. So you're comparing those two. In the other method, by selecting the discount rate that balances the cash inflows and outflows, basically your net present value is 0. That's called the internal rate of return. So a project with an internal rate of return of 19.5%, for instance, is better than a project with an internal rate of return of 18.5. So the higher, the better. Chapter 6 deals with systematic approach to exploration, and as with other aspects of mining economics, the economic assessment of mineral deposits is subject to two powerful influences, namely the time value of money, which was Chapter 5, and the economics of information. It is the second of these, the extra value from the extra information after extra drilling, that's the major focus of attention on this chapter. We're not going to go into depth in this chapter. I want to make our focus on the last section of the chapter, which aims at understanding how fixed costs, variable costs, and the time value of money influence decisions as to whether particular parts of the deposit are viable or not. Pit optimization is the key economic tool for valuing reserves and controlling the strategy for development of most open pit mines. As mines get deeper and as grades and other ore body characteristics change, the pit optimization technique determines whether the next block of material to be mined is classified as ore or waste, considered economic or non-economic, and included in or excluded from the mine plan. So for material to be included in the plan as economic, then at a minimum, the extra return from the extra effort, which is to remove the extra waste above it, mine it, and process it, etc., must exceed the extra costs incurred. In the last chapter, or in the last, chapter 4, we were talking about marginal costs and marginal revenue or marginal returns. That's exactly what we're talking about. So if it's included in the mine as economic, I'm going to repeat this, at a minimum, the extra return, the marginal return, from the extra effort, which are the marginal costs, must exceed the extra costs. So the marginal return needs to exceed the marginal cost. This is on page 87 of your book also, and this is also part of our exercise that you'll have. On a standalone basis, a block may be profitable, but there may be mutually exclusive and even better mining sequences that precludes mining of the block. So instead of just taking all of block 1, you might do just the tops down to the top seam until you get to a certain block, and then it becomes economically feasible. The decision to include or exclude it from the reserves estimate is also a function of the mining schedule. We're going to do an example this week based on the diagram above to demonstrate how we decide when it is economical to pursue a particular option. So exercise 2, which is all on a spreadsheet, will have you determine when it becomes economical to go after the lower coal seam. As the depth of overburden increases, it becomes more costly to mine the upper coal stream, obviously. And interburden between the upper coal seam and lower coal seam is a constant 25 feet in this example. As if economics, as we've discussed in the first few chapters, wasn't hard enough to understand, now we need to consider the differences between micro and macroeconomics. It's not covered in the text, but I want to put what we are learning in perspective. So when you think of microeconomics, think of a microscope. You're analyzing one little bit of information at a time. In microeconomics, we tend to focus on one individual, one firm, one industry, and how it interacts with that particular market. Examples include, should we increase our salaries for our employees? Deciding when to buy a new dragline. Should we increase our mine production? Profit maximization for our company is a microeconomic issue. Now imagine you're standing on the moon looking at the economy on Earth. You would see a huge land masses only. This faraway approach is considered a macro approach because it aggregates all the decisions of the individuals and firms to a regional or national level. So macroeconomic is really the economy as a whole. Macro tends to focus on government policy and the potential impacts it has on the general economy. Government policies include taxes, subsidies, regulations, and rules. Macroeconomics strives to understand how these policies impact the economy, and in our case, how those macroeconomic policies impact the mining industry as a whole. Inflation, unemployment, gross domestic product, trade, exchange rate, those are all macroeconomic issues. Remember, microeconomic or micro focuses on the individual, the company, and decisions they make. Macro focuses on countries and indices like GDP, inflation, and unemployment. Now, included in this week's lesson is a short and simple explanation of the difference between micro and macroeconomics. Doesn't take long, and if you have trouble understanding it, please let me know. I think you'll be fine with it. It's pretty simple to understand. All right, have a great day. Thanks.